Welcome to the BioPharma Business Intelligence Unit, where symbolic integrity meets strategic clarity. At BBIU, we go beyond the headlines to decode the structural forces behind global biopharma, AI, and economic realignment. If you value precision, verification, and symbolic depth, this channel is for you. Subscribe now to access our weekly briefings, dossiers, and intelligence reports, and consider joining our institutional tier to unlock early warning systems, custom metrics, and exclusive strategic insight. You're not just listening, you're entering the future of epistemic intelligence. www.BioPharma
Government's overdraft with Bank of Korea nears $150 trillion, Record signal of fiscal strain sources. Chosun Ilbo, Mail Ilbo, Jungang Daily, Korea Economic Daily, Munhwa Ilbo. Executive Summary. Between January and August 2025, the South Korean government borrowed a cumulative $145.5 trillion from $104 from the Bank of Korea (K) through its temporary overdraft facility, informally described as a minus account, matung. This surpasses the previous record of $127.9 trillion in the same period of 2024, a 13.8% increase. Monthly borrowing highlights: January 5.74, February 1.55, March 40.5, 28.9, April 23.0, June 17.9, July 25.3, August 31.6, 22.6. The outstanding balance stood at 22.9 tenths, 16.4 at the end of August. The 2026 national budget has been set at 728,520 tenths, up 8.1% from the 2025 budget of $673,481. To cover persistent shortfalls, the government plans to issue over 171.10 in deficit bonds next year. BBIU opinion: South Korea's domestic debt spiral, from BOK overdraft to pension capture. South Korea's fiscal trajectory in 2025-2026 reveals a dangerous pattern: increasing reliance on the Bank of Korea's overdraft facility, Hanin Matong, record issuance of deficit bonds, and creeping absorption of state debt by domestic financial institutions, including the National Pension Service, NPS. At the same time, the industrial base is eroding through the outflow of conglomerates toward the U.S. and the introduction of new regressive taxes, e.g., sugar tax, that shift the fiscal burden onto households. While official yields remain artificially low, 2.8% for 10-year bonds, this masks a structural trap. Interest payments already consume 1% of GDP and are projected to rise to 1.3% in 2026, potentially doubling to 2.5% if yields normalize upward. The situation is reminiscent of Argentina's decades-long cycle of monetization, pension fund capture, industrial flight, and regressive taxation. Key structural factors. Chronic fiscal deficit. Tax revenue has consistently underperformed, reflecting weaker exports, slowing domestic demand, and demographic pressures. Spending, however, is accelerating. The 2026 budget is set at $728 up 8.1% year-on-year. 2. Monetization through bouquet overdraft. The government borrowed $145.5 from the Bank of Korea between January and August 2025, surpassing all records. This is not part of the consolidated debt stock, but it functions as de facto monetization of shortfalls, eroding confidence in fiscal discipline. 3. Rising domestic debt and interest costs. Public debt will reach 250 ton 809 in 2026, 55% of GDP. Interest payments 3025, 1% of GDP, projected 3610 2026, 1.2 to 1.3% of GDP. If yields rise by plus 1 to 2%, the cost could climb to 50 to 60 tet, 2 to 2.5% of GDP, crowding out productive spending. 4. Financial system distortion. Domestic banks and insurers buy government bonds not for yield, but under regulatory and political pressure. In effect, KTBs are an implicit tax on the financial system, draining capital from productive lending. 5. Pension capture risk. The National Pension Service, NPS, the world's third largest fund, $700 billion, may be forced to absorb more low-yield KTBs if foreign investors reduce their exposure. This would compromise returns and jeopardize intergenerational pension sustainability and expropriation by stealth. 6. Industrial erosion and regressive taxes. Chaebols are relocating capital and capacity to the U.S., semiconductors, shipbuilding, defense, hollowing out the domestic tax base. The government compensates with new consumption taxes, e.g., sugar tax, shifting the burden onto households and SMEs. This marks the onset of fiscal extraction from below rather than taxation of productive surpluses. Comparative lens, the Argentine parallel. The Korean case echoes Argentina's trajectory: monetization of deficits, both overdraft, Argentina's central bank, adelantos transitorios, pension fund capture, NPS as Korea's version of ANSYS, industrial exodus, chaebol shift to US, Argentine capital flight, regressive taxation, sugar tax, Argentina's impuesto al cheque or food levies, interest spiral, growing share of GDP consumed by debt service. The difference is that Korea still has strong industrial champions and international credibility, but the structural logic of fiscal dependence is alarmingly similar. BBIU structured opinion. South Korea is entering a domestic debt spiral with three reinforcing mechanisms: liquidity, monetization, reliance on the bouquet overdraft to smooth deficits, signal of fiscal weakness; pension capture, forced absorption of government bonds by NPS and domestic banks, erosion of future returns; regressive taxation, new levies on consumption to replace eroding industrial revenues, social legitimacy cost. This triad reflects a transition from a growth-based fiscal model to an extraction-based survival model. Symbolically, Korea risks becoming the first advanced Asian economy to mirror Argentina's debt trap, albeit under different geopolitical conditions. Annex: South Korea's Fiscal Sustainability Outlook, 2025 to 2028. South Korea's fiscal trajectory is under increasing scrutiny as domestic borrowing, reliance on Bank of Korea (BOK) overdrafts, expanding deficit bond issuance, and rising interest payments converge with structural industrial erosion and geopolitical commitments in US dollars. This annex outlines a realistic projection through 2028, highlighting fiscal, social, and external risks. The projection identifies three phases: I, containment and cost displacement, late 25, mid-2026. 2. Composite stress and pre-electoral distortions, late 2026, mid-2027. 3. Forced normalization, late 2027-2028. The most likely outcome is recourse to an IMF program by 2027, triggered not by insolvency in KRW, but by a balance of payments crisis linked to dollar obligations. Phase 1. Containment and cost displacement, Q 2025 to H1 2026. Debt to GDP ratio, 51%, projected 54-55% following 2026 issuance. Interest rate burden, 1.2 to 1.3% of GDP, 36-26 was. Carat of 329 to 500 with potential spikes above 1.520 under dollar strength. 10-year KTB yield 2.8 to 3.4%. Policy measures: expanded budget 528 pen 20 for 2026, introduction of new consumption-based taxes, e.g. sugar tax. Social indicators: rising youth discontent, employment precarity, housing costs, but limited large-scale mobilization. Risks: external dollar shocks, oil, LNG, Fed policy. Logistical financial stress on LNG contracts, foreign capital outflows affecting KTB and equity markets. Phase 2, composite stress and pre-electoral distortions, H2 2026, H1 2027. KRW 101,650 as a de facto accepted band. 10-year KTB yield 3.6 to 4.3% baseline, up to 4.8% in case of foreign sell-offs. Interest burden, 1.5 to 1.8% of GDP, and 48 to 50, 35 to 36B. Domestic financial system, banks and insurers further constrained by forced absorption of KTBs. National Pension Service, NPS, increases exposure to sovereign bonds, reducing long-term returns. Crowding out of private credit accelerates. Fiscal strategy, broadened regressive taxation, continued social spending, increasing reliance on BOK liquidity. Political dynamics. If electoral defeat looms, commitments are shifted forward, leaving unfunded liabilities and rigid contracts for the next administration. Geoeconomic risks, U.S. retaliation through tariffs, autos, semiconductors, if Korea attempts to reinterpret or delay LNG purchase commitments. Phase 3, forced normalization, H2 2027 to 2028. Trigger, depletion of usable reserves or sharp increase in USD hedging costs for corporates. Adjustment mechanism, negotiation of an IMF program, standby or less likely, flexible credit line. Projected conditions, multi-year fiscal consolidation path, return to primary surplus in 2 to 3 years. Tax measures, higher VAT, elimination of exemptions, environmental levies. pension reform, NPS age thresholds, benefit formulas, and statutory caps on sovereign bond exposure. Debt rule and prohibition of BOK overdraft financing. Gradual release of domestic banks from mandatory KTB absorption. More flexible KRW-USD regime with buffer building in reserves. Economic outcomes. KRW stabilizes at a weaker baseline with reduced volatility. Bond yields decline as market confidence is restored. Social cost at onset. Higher taxes, reduced transfers, but medium-term stabilization. Social and political sustainability. Youth demographic. Rising frustration with high taxation, limited job prospects, and low pension expectations. Early signals of political awakening mirror trends in Argentina. Legitimacy. Erosion of confidence as citizens perceive higher debt with limited public benefit. Protest risk. Moderate in 2025, higher in 2026 as new taxes and rising import costs feed into household budgets, potentially escalating if paired with external trade shocks. Political strategy. The current administration likely sustains policies until elections, leaving time bombs, commitments in USD, rigid spending mandates for successors. Early warning indicators. KRW-USD, persistent weekly closes above 520, sharp widening of forward premiums. KTB 10Y, UST 10Y spread, unexplained widening suggesting foreign exit. NPS allocation shifts, sudden increases in sovereign bond holdings. BOK balance sheet, expansion of sovereign debt holdings or aggressive USD swaps. LNG contracts, delays, renegotiation signals, or volume adjustments. U.S. tariffs, leaks, or formal announcements targeting autos, EVs. Strategic options for a successor government. Establish a credible fiscal rule and phased consolidation plan. Protect NPS autonomy and restrict forced bond absorption. Restructure taxation toward neutrality. Higher VAT with targeted rebates, reduction of regressive levies. Hedge LNG contracts and diversify energy imports. Redesign bilateral contracts with U.S. to include auditable flexibility clauses. Free up banking balance sheets to restore productive lending. Conclusion. South Korea faces a trajectory where domestic debt dynamics, industrial hollowing, and dollar obligations converge into a structural vulnerability. Current policies will likely sustain until the next election, at which point accumulated commitments will create acute fiscal and external stress. Unless corrective measures are adopted early, the baseline scenario is a recourse to IMF assistance by 2027, marking the shift from discretionary expansion to externally supervised stabilization.